Private credit markets have seen explosive growth over the course of recent years, and one of the leading players in Australia has been La Trobe Financial. I spoke to the CEO, Chris Andrews, about their strategy, why it's been successful, and what has led them to expand into the US market. Take a listen. Chris, La Trobe is a name that would be familiar to some, but not everyone. For those who aren't familiar with the organisation, provide a sense of what you guys do.
Well, we've been around since 1952, Tom. So, over 7 decades in the asset class now. What we've focused on across our history is private market investments. So we focus on Australian real estate private credit, which is loans to a very granular set of borrowers across Australia. Could be residential loans, could be commercial loans. Across Australia, diversified portfolios. And what we're trying to produce is really consistent, reliable returns for our investors. So that's something we've been doing now for many, many years. These days, 120,000 plus investors, growing fast. We're adding new products to our offering. So some years ago, we launched a US mid-market private credit strategy. We've got more strategies coming in the pipeline too. So, lots of exciting things ahead.
When you look at those 120,000 customers that you have, what is it that attracts them towards the products that La Trobe has on offer?
So the first thing is they've got to really trust the manager. We've really lent in over the years, Tom, to things like transparency, really friendly human service. We always want to make ourselves available to our investors so that any questions, any concerns, any issues that they have, they can always feel very free to escalate to us. Beyond that though, one of the things that we're always thinking about is 85% of our investors are over 55. So what we are trying to produce for those investors, we're not chasing the highest yields in market. We're trying to be that really solid, conservative capital preservation model. That's what we're targeting for investors.
I suppose there was a time where the landscape that you occupy was very different. It wasn't as transparent. The risk that was associated with the lending was far different. How have things changed over the course of the last couple of decades in particular?
Yeah, as we look across markets, Tom, there's still some work to do. There's no doubt about it. And I always say to any investor, if you can't understand what's going on under the hood with your manager, you've really got to be asking whether you should invest with them. We try to lean in really heavily to reporting every month on everything that's going on in our loans. Now, we appreciate some investors don't want to pore over every single monthly report in the fine detail we provide it. But as an investor, you've got to just keep testing yourself. Can you understand what's going on under the hood? And what we're super pleased with is, if you look, ASIC are doing a review on sort of reporting standards across the industry at the moment. All of that is wonderful for investors, and frankly, it's wonderful for managers too. Everyone benefits when you've got a well-ordered, when you've got a really transparent market.
So obviously you've got some very important boxes that you need to tick when it comes to your approach to lending. What's the most important box that you need ticked?
Can I give you 2?
Sure.
So there's 2 boxes we think about all the time. First thing is quality of assets. It's one thing to raise money, it's another, you can lend money. The question always with money is not so much can you lend it, the question is can you get it back? So quality of assets is the first thing. The other thing we spend a lot of time thinking about is the liquidity and funding framework that unlocks that deal flow, but also ensures that investors have a really smooth experience. So as an investment manager, sort of quality of asset and quality of your liquidity and funding profile is critical.
In terms of your demographic, as you said, they tend to be a little bit older. Is there an opportunity to open that market up to younger people who perhaps might not be familiar with La Trobe, but are desperately trying to establish a nest egg to get a foothold in their investment journey? Why isn't that group as engaged, perhaps?
Oh, it's an amazing demographic and one that we are super happy to serve too, Tom. And certainly more and more. Once upon a time, a young Australian would probably, their first investment would be into their house. That's getting harder and harder for so many young Australians, which is a problem for us as a nation that we need to address. But certainly as an investment manager, that means we are seeing more and more young investors taking positions in managed funds, getting invested in listed investment trusts, as a way to start building wealth and eventually accumulate something that they might use to buy a house. So we're seeing that journey more and more.
In terms of private credit specifically, this is from time to time an area that's misunderstood. Why do you think it's perhaps shrouded in that mystique that makes people a little bit wary?
Labels.
Right.
Labels. It's really straightforward. What our business model, Tom, is really simple. A borrower comes through the door and asks for a loan. We do a really rigorous credit assessment. If we're happy with that borrower, we'll do the loan. We'll take a first registered mortgage. Our US private credit strategy is similar, except that we'll be doing a loan to a company in the US mid-market. So there's nothing to be scared of around the labels. Private credit is simply a vehicle by which you can access a really strong underlying asset class, the Australian, sort of middle Australia, if you like, and the US mid-market in our cases. So I'd always say to investors, don't get fussed about the labels. People have referred to our funds in all sorts of ways over the years, mostly complimentary, but certainly, putting aside the labels, what you're looking for is an investment offering that has quality assets and quality liquidity and funding structures sitting behind it. And if you've got those two things, you're most of the way there to having a really good investment experience.
La Trobe's in a unique position to be able to compare the Australian experience with your US experience. What is the key difference between the two markets for you?
Yeah, so the US mid-market at the moment is booming, Tom. I think both sides of US politics decided, sort of 10 years ago with the Make America Great Again, that became the Inflation Reduction Act. Now we're back with the Republicans, and all of the financial resources of the US are absolutely targeted at rebuilding that part of the economy. So we're seeing incredible dynamism there. It's not a straight line. It's absolutely clear what's going on in the world at the moment is a little bit unusual, so it's not a straight line, but both sides of politics are absolutely focused on rebuilding that. So what we're seeing in the US is that creative dynamism that they excel at. Whereas in Australia, what are we seeing? We're seeing very consistent. We'd love to see growth a little bit stronger. We'd love to see productivity a little bit higher, but we just see that Australian economy ticking away, chugging away, frankly, as it's done for the last now 35 years.
We seem to be on the cusp of seeing another leg lower as far as interest rates are concerned, both locally and offshore, in the US in particular. What sort of a difference is that going to make in terms of the demand for your products?
Yeah. Always, we've watched this across many interest rate cycles, Tom, and what we see is consistent demand. In fact, we've got a great chart internally that we often look at, and folks ask us, if rates are high, does that help? If rates are low, does that help? And you can't see any difference. So what are investors looking for when they come to us? They're looking for something of a margin over cash or bank bills or whatever your relevant benchmark is, and we've shown that we can consistently produce that across many, many decades. So that's really what gets investors interested in our offerings.
We've been in a falling interest rate environment for a while, and that can sometimes mask some of the, I suppose, fault lines in an economy or in a particular lending landscape. Is there anything that you're particularly conscious of that you have to always be attentive to, regardless of whether or not it's a falling or rising interest rate environment?
Yeah, I'd say it's just 3 years since the Australian economy was subjected to an instant stress test with 4.25 percentage points of interest rate increases in about 12 months. So that was a really substantial test of credit standards across Australia. And certainly in our business, we found our borrowers extraordinarily resilient. And I think by and large across the industry, that was a general finding, and it was contrary to what some expected. What are we looking for now as we head into this next phase of the global economy and the potentially a downward rate cycle? Although, Tom, who knows what we're going to be saying next week, but I certainly agree is that's the way it looks right now. So we're looking for businesses that have overextended themselves over the last 3 years, sometimes because COVID-related stress, sometimes because they're trade exposed. So we're looking at those sorts of businesses and those sorts of borrowers with a very careful eye. And I don't think there's particular sectors. There were some, 2 or 3 years ago, we were looking at some parts of the Australian economy. Hospitality was under pressure. The worst of that mostly seems to have washed through the system now, and we're seeing, in fact, some of those places are starting to benefit from the fact that there's actually a shortage shortage of supply of high quality property, which means those that are well situated and have good thriving businesses are starting to see their financials turning around.
There seems to be a push from every level of government nationally now to create more affordable housing for people. How much of an opportunity does that represent for your organisation?
Well, it's a wonderful opportunity for our business, and it's a signal challenge for the country, Tom. You know, if we are going to maintain the compact in Australia of keeping the Australian dream alive, we need to be able to provide affordable housing in reasonable locations for our younger generations. And, you know, this is something I think about a lot with my wife. We've got 4 young kids, and we think about what they're going to do in the next stage of their life. So certainly as a nation, that's something we've got to really step up to. And we're following the headlines, new announcements about new precincts being opened for housing. We need to lean in. It's all very well for those of us who've been fortunate enough to get our own piece of the Australian dream, to cling on to what we've got. But if we don't make room for the next generation, they'll take it themselves. Look, as a business at La Trobe Financial, that's a wonderful opportunity. We specialise in that sort of infill development, that middle density sort of development, smaller apartment blocks, townhouses, these sorts of things. And if you look across the great cities of Australia, Sydney, Brisbane, Melbourne, Adelaide, Perth, Hobart, there are so many opportunities to really fill in that middle ring around the cities with those sorts of developments. And, you know, given the rate of population growth in Australia, that's going to be an incredible part of the La Trobe story for the next 20 or 30 years.
Given what you've just described, I suppose that one of the challenges is to make sure that you're growing at a rate that's sustainable, that doesn't sort of become out of sync with, you know, your standards. Is that something that you're conscious of?
Yeah, so for us, it's always about disciplined growth, Tom. And I think everything you've heard today, you know, we focus on quality of asset and we focus on the quality of our liquidity and funding platform. And we keep saying if we keep those two things right, and you've got to grow them in tandem, you've got to make sure you're not overreaching and looking into, you know, a classic error that we've seen over the years from some asset managers as they grow is they start to stretch into, you know, assets that are perhaps outside their mandate and capability and experience set. We're super conscious of that, and we've had a very consistent approach to our investments over the years.
And Chris, I suppose a very exciting initiative for La Trobe has been the fact that you've just recently launched a LIC as well.
Yes, we were super keen for Australian investors to be able to access our offerings on the Australian Stock Exchange, Tom. So it's LF1 was launched in June. We've been so pleased to see we've got sort of over 3,000 investors in that vehicle now who are actively buying and selling, and we're really excited to be on the ASX, and we'll be looking to do more of that in the future.
What was that moment where you thought the time was right for La Trobe to launch this type of vehicle?
Well, it's actually something that folks have been asking for some time. So we obviously deal with about 5,000 advisors across the country, and we've often heard from financial advisors that some of their clients prefer to manage their affairs all on the ASX. So for us, it was a pretty easy hit. They're investing in our underlying strategies, a sort of a blended mix of our Australian real estate private credit strategies and our US private credit strategies. So that's been very well received by the market. So,
Chris, again, it's been a pleasure talking to you today. Thanks for your time.
Thanks, Tom.
And thanks for joining us for the Executive Series.